And thank you again for tuning in for another quarter report review. I know it's already somehow the end of February, but Happy New Year, and hope everyone's had a great start to 2024. I know here at ITR, we keep dropping that R word, recession, for 2024, but I want to unpack that a little bit today, talk some more positive notes that we are seeing in some of the economic trends, and again, the strategies that can be deployed to maybe avoid this manufacturing recession in your own sales. Before we dig in today, something that we like to do at the end of every year is grade ourselves. Effectively, ITR's accuracy hopefully allows for confidence while strategically planning your business over the next 4, 8, 12 quarters. And so what we do at the end of every single year is we look at a bevy of our forecasts, the same grouping every single year: US GDP, US industrial production, to essentially hold ourselves accountable. And we create these forecasts with a duration in place that hopefully gives folks enough time to plan. So that duration column is how many months ago we made each one of these forecasts. So for example, the GDP forecast for 2023 was made 15 months before the end of 2023, so back towards the end of 2022. And that forecast that we made in 2022 for 2023 was about 97.8% accuracy, and that's really what we're targeting. We have a threshold of about 94.7% that we are hold ourselves accountable towards. If you look at this list, there is one forecast that fell short. The housing market has just faced a lot of whiplash. We saw a lot of rapid deterioration within housing towards the second half of 2022 into 2023 as a response or result of a rapid change in the interest rate environment. And so the dust is still settling from that activity, but there is some positive green shoots showing within the housing market. So we're seeing some opportunities there heading into 2024, especially the back half of this year. Now, with that said, we don't just forecast the broader macroeconomic trends. We're looking at your data specifically, and this is our outlook for MTI's average monthly sales. Now, on the left, we have a 12-month moving average. In blue is the data history. In gold, that's the forecast. Now, we are talking about decline likely in the coming quarters, but I'm going to speak to some of the upside potential within this market because we think there's some potential for this forecast to track near the upper end of our range. Now, businesses, consumers, they've been relatively resilient despite some of the contractionary monetary policy, the higher interest rates, the tightening of money supply, and that's in part assisted by reshoring activity, government investments in infrastructure, and overall elevated cash holdings. And that's helping mitigate or mute some of the impacts of interest rates. So while this forecast we decided to keep in place for this report delivery, I do want to speak to some of the upside potential here. Now, the chart to the right, that is the rates of change, or those are the rates of change from a 12-12 perspective, 3-12 perspective for MTI's average monthly sales. You can see the 3-12 and 12-12 are both in a slowing growth pattern right now. The expectation is to see that turn into negative rates of change territory in the coming quarters. Want to emphasize that while we are talking about phase D recession, there's still opportunities to really plan for this year, really assess those net cash generation expectations that you have given a forecast of slowing rise for the industry. And that maybe it's a little different from when budgets have been prepared. And what we want you to do is input any increase to cash from optimizing operations and other changes such as process efficiencies and what have you, and use that to deploy into potential capital expenditures and other long-term efficiency gains to really set yourselves up for when that growth reemerges in 2025. And we again want you to assess those cash needs for the economic expansion during that time period, and also make sure that you are improving your efficiency, looking at those capital expenditures that you can make to help really loosen up any sorts of bottlenecks that will be present when business demands increase in 2025, and really find ways to help your labor situation produce more labor efficiency, because that is a challenge that's going to continue to present itself for the remainder of this decade. So quick synopsis on your forecast. We are talking about a contraction in 2024. Some of the positive signals or maybe upside potential for that forecast we'll get into when we talk about some of these key macroeconomic trends, but we can see the overall outcome for 24 trending more towards the upper range of our forecast. Now, with that said, we are talking about seeing this recession within the data really end in 2024, showcasing signs of recovery for 2025 and ending 2025 above 2024, and seeing that growth continue with 2026 above 2025. So again, want to use 2024 as an opportunity year. Slower demands gives you opportunity to really evaluate your business and prepare for that longer term growth. Now, with that said, let's talk about the macroeconomic trends. And the big one that I know gets shown up a lot in the headlines that we talk about here at ITR and it's GDP. And this is our new revised gross domestic product forecast. And this is real GDP, meaning it's adjusted for inflation. Now, what we were previously speaking to for 2024 was a flat GDP, really mild decline of about negative 0.4% in GDP year over year. But results for the second half of 2023 were running stronger than we had previously anticipated. We can look into factors like the administration's spending on infrastructure and investment via the CHIPS Act and the infrastructure spending bill. We're also recognizing that real personal income has played a role with a more resilient consumer whose income continues to grow despite having a worsening credit card position and worsening savings balance. This is also helping the economy truck along. And lastly, cash held by corporations did not decline as far as we expected. And in fact, overall corporate cash is pretty elevated, not quite the record high levels of late 2021, but still elevated from a historical precedent. Now, some of the downsides still persist for 2024. We're talking about money supply and those credit card delinquency rates, exports from the US to the rest of the world, as well as corporate profits, all suggest that 24 will be a slowing growth year, but our new revised forecast is for growth this year in the US gross domestic product. And one thing to point out is GDP includes a lot of different variables. You have the consumer spending on services versus the consumer spending on goods. You have inventory buildup for businesses relative to inventory investments. And then you have the government expenditures. And so if we were to drill down a little bit further into a core macro indicator as it relates to MTI, we can look at just the industrial production index relative to GDP. And GDP is in dark blue, whereas that 312 rate of change for US industrial production is in light blue. And this is showcasing signs of weakening. That 312 rate of change has dipped negative. It's kind of waffling around that zero line with expected more downside pressure. And our expectations is to see, again, a 312 rate of change and consequently a 1212 rate of change that will hit recessionary territory this year, followed by recovery into 2025 and growth. Now, in your report, we present U.S. industrial production, and the forecast we included in there is for a 1212 rate of change. I just want to note that this light blue line is a 312 rate of change, which tends to lead the 1212 rates of change. That is showcasing our forecast of an upcoming low point in the industrial production index 312 rate of change in the next 2 quarters, followed by 2 consecutive quarters of negative rates of change, but getting less negative in the 312 rates of change. Now, one thing to again point out, similar to GDP, middle and upper income consumers are providing resilience despite the jump in price level in recent years and tighter lending conditions. When we think about the business to business side, large cash buffers have partly offset the downside effects of monetary policy. And those are the factors that have led to revised outlooks for GDP and employment and single unit housing. In the case of industrial production, our analysis suggests that the results will trend closer to the upper bound of our forecast rather than the median, similar to our expectations for MTI's average sales. Core drivers here, the lagged effects of monetary policy, below average business confidence, and lower utilization rates of existing capacity all still suggest decline is probable this year. And many of our industrial clients here at ITR and many of the industrial segments are already showcasing signs of a hard landing. And it's always an important reminder that not all segments of the economy, not all businesses within the economy feel the effects the same way. And so this is just a snapshot of the ITR Trends 10. We pulled this from our subscription series, the Trends Report, that has a bunch of different insights in it, but we like to visualize this one here that looks at a variety of different indicators or segments of the macro economy and then visualizes what current phase of the business cycle each one of these operates in. And when we look from, say, right to left, I know it's usually normal for us to go left to right, but I'll start right to left. Housing and the financial sectors are in a phase A recovery. And as a reminder, phase A recovery, that does not mean growth. What it means is that those rates of change are negative, but getting less negative, heading towards growth. That's our general expectation, especially for housing, is to showcase signs of growth by the end of this year. If we follow this back, from right to left, wholesale trade is in phase D recession, negative 12 rates of change, getting more negative. And that is really in part due to the elevated inventory levels within the broader economy, still presenting a challenge as businesses try to rebalance those inventory levels. It's slowing down trade. And there's, again, working our way left to right, a variety of macroeconomic indicators that are still in that slowing growth cycle. Broader industrial production still in slowing growth, just barely positive. But if we look specifically at manufacturing, which is a subset of industrial production, manufacturing has already dipped into negative rate of change territory. And then following it further back, if we look at things like consumer prices, those are in a disinflation trend still. Producer price index is also in disinflation. We'll talk about the pricing environment a little bit later today. And then following this further to the left, you can see non-residential construction still in phase B accelerated growth. Our general expectations is for non-residential construction to hit a high point and then transition to a slowing growth environment. But there are still some segments of non-residential construction showcasing signs of growth and maybe even a delay in turning to slowing growth. Some of those stronger performers are manufacturing construction or late cycle verticals like the education construction. Infrastructure construction, as we mentioned, the federal government has continue to place a lot of emphasis on that infrastructure spending bill, and that has definitely showcased some signs of strength in part of the bump within the economy. But as I mentioned and cited, some of the more negative indicators are circled around a lot of what we've talked about in the past, but the monetary policy environment and the interest rate environment. This is looking at the US government long-term bond yields, and you can just see how quickly the bond yields ratcheted upwards, and that just created a lot of near-term pressure at 4.26%. It is definitely well above what it has been since the post-Great Recession era. But with that said, historically speaking, this is still a very moderate level of long-term bond yields. We are still just dealing with a lot of the whiplash from a rapid tightening within monetary policy. But we can operate at these levels, and overall, our expectations here at ITR is to just see mild decline, especially in the second half of 2024, as the impacts of monetary policy start to showcase signs of easing. And that's based upon the expectations from the Fed, but also as inflation continues to disinflate and also factoring in the overall weakening within the broader macroeconomy. Those will all place downside pressure in long-term bond yields. And what that means for you and your business is late 2024, potentially early 2025, there might be a good opportunity to take advantage of a cooler, lighter, looser bond yield or interest rate environment. And keeping in view the long-term perspective that ITR has is that we anticipate the back half of this decade to be more inflationary, with higher levels of inflation than we experienced during the 2010s. And commiserate with that is higher bond rates, higher interest rates. So use that planning to your advantage. As I mentioned, part of this expected decline is underpinned by the Fed's expectations. And I say part of it. There are other factors that are going to place downward pressure on bond yields. But if we look at just the Fed Open Market Committee's expectations, this chart here is a dot plot. Each one of those red dots represents a member of the Fed Open Market Committee and what their expectations are for the interest rates, or really the Federal Reserve target rate, federal funds target rate. And what we are seeing and what their tone is signaling right now is a modest drop in 2024, somewhere between 50 basis points to 100 basis points is the broader clustering of those dots there, followed by a more pronounced drop in 2025 to more like a 3.5% range for the Fed Reserve target rate. Now, with that said, when I look out at that longer term, 2026, and the longer run, those dot plots are working their way down to 2.5%. And what I want to do is say those are generally aspirational. The goal or the expectations of the Federal Reserve is to always see the federal funds target rate return to 2.5%. That is not always underpinned by analysis. When we looked at this dot plot back in 2021, the longer run expectations were also to trend around 2.5%. And now that we are in 2024, that is the longer run from 2021, and we certainly are not at 2.5%. So take those with a grain of salt. That 2026 and longer run expectations of the Fed, ITR is making sure that we are emphasizing that interest rates and inflation likely to pick back up in 25, 26, and beyond. So take advantage of the lower interest rates to come this year into early next year. Make your acquisitions, invest in your products, innovate, make sure that you are planning for the growth that is anticipated in 25 and 26, and really how you can gain some market share. All that is to say, we expect the end of this year to reflect a transition in the inflation rate environment, going from disinflation back to reacceleration in inflation. And can see that in this chart here. This is a comparison between the US Consumer Price Index to the Global Supply Chain Pressure Index. And the dark blue line is the Consumer Price Index, and the light blue line is the Supply Chain Pressure Index. And these tend to have a decent correlation with the supply chain pressures leading by about 8 months. They definitely help us explain the pressures and the challenges of inflation of that post-COVID sugar rush in late 2020, 2021, 2022. And we can also see the downward pressure that a loosening supply chain network has placed on the Consumer Price Index. And that's really a fundamental of macroeconomics. Supply and demand, they help govern a lot of things that go on. Now, with that said, we have our orbs in place here. The little dots there coming out of the Consumer Price Index, showcasing further signs of disinflation. If you look at present day, the dark blue line right around the end of 23 and early 24, it's kind of moved a little horizontally, a little bit of a lip up there. We're monitoring this. The broader term theme has been disinflation. The risk is that the Federal Reserve looks at these factors of a strengthening or strong GDP and consumer prices not in an outright decline anymore, and potentially delaying bringing down the federal funds target rate that could push some of the downside pressure into 2025, a risk that I know we've talked about, but continue to monitor here. We haven't revised our forecast, but what we do showcase on the backside, once we kind of get out of this monetary tightening period, is more inflation, trending closer to 3 to 5% for the remainder of this decade. What that means is when you factor in your decision-making for acquiring new inventory or locking in your contracts or negotiating your labor, plan for higher levels of inflation to come in 2025 and beyond, and get in front of it. This year is a great year to get in front of a pickback or reignition of inflation. Not saying that we're heading back towards what we experienced in the outfall of COVID, but definitely higher than what we have been previously expected from inflation from the 2010s. So make sure you're planning for that. One risk I wanted to highlight as it relates to inflation, looking at this chart, that light blue line, the supply chain pressure index, has worked its way back towards the zero line in a pretty quick fashion. And there are definitely non-economic risks that are embedded in there, and want to present just the factor that Middle East tensions and trade flow through the Suez Canal, as well as drought conditions in South America, and the impacts that has had on Panama Canal capacity. And those have some potential to place upside pressure on prices between oil costs and freight costs, all rippling through. We continue to monitor these impacts. They have not resulted in us revising our forecast, but it's always a great reminder that we should constantly evaluate, reevaluate supply chains for risk and ensure that there's redundancy and resilience built into your own supply chains, so that if you have exposure to the Middle Eastern tensions or the climate challenges in the South America, Central America region, make sure that you are a little more insulated from potential risk and challenges in the future. Now, while we're on the concept or discussion point of inflation, want to move from the consumer price index to the producer price index. And this has two charts. The one on the left are the rates of change in the producer price index, and the one on the right is just the overall data trends, the 3-month moving average in gray line and the 12-month moving average in green. Now, while we weren't expecting deflation in the consumer price index, we are expecting it in the producer price index, meaning that prices are expected to fall this year. And we can see that already in the left chart. The 112 rates of change have poked negative. The expectation is that the 12/12 rate of change will follow. But one thing to point out is that we do not expect prices to really even sniff the pre-COVID levels. Higher prices should be factored into your long-term planning, but take advantage of this brief dip in 2024, early 2025, to adjust your inventory levels for 24 and prepare for 25, and use this buy low high dichotomy to your advantage. Make sure that you're appropriately sizing those inventories to plan a cycle ahead. And what that means is you might have a good opportunity towards the latter part of this year to renegotiate, lock in on some contracts, and prepare for the growth in 2025. Now, countering some of those raw material costs that have been coming down in 2023 is the labor market. And so I wanted to check in on the labor market as well. Thinking about just overall aggregate level of job openings is showcasing signs of easing. They're still very elevated from a historical context, but that was the long-term trend where job openings continue to climb upwards. If we just draw a straight line through those long-term trends of non-farm job openings, you can see that the monthly trend has fallen a bit below the long-term trend, and then the 12-month moving average is right on par with the longer-term trajectory. So two ways to read this. Yes, things are getting easier, but no, we do not expect them to get easy. And the effect of that is just a persistently tight labor market that's going to continue to place upside pressure on wages. And this is just a snapshot of average hourly earnings throughout various segments of the economy, looking at the wholesale trade workers, construction workers, manufacturing, professional and tech, and so on. And the middle column there, the earnings per hour, is just the dollars per hour. It's an earnings figure. And then it looks at the 112 rate of change. And what that 112 rate of change is considering is the January 2023, or sorry, the January 2024 level of those earnings relative to the January 2023 levels. And then comparing that to the 5-year average under a very similar snapshot. And you can see construction, manufacturing still elevated, but the broader theme is that most of these average hourly earnings have been easing and softening. Now, what we get further support, or where we get further support, that declining quit rates are going to help with the labor environment. Higher retention will be the theme in 2024. some easing hiring activities in 2024, and you might have a little more leverage towards the end of this year, again, considering what those long-term labor needs are, and also how long it takes you to train employees to become productive. If you think about 2025 being a growth year, and it takes a full year to onboard a new associate, then consider the hiring practices of potentially getting that person on board sooner so that they can be productive in 2025. You don't want to be trying to train all these new employees during an accelerated growth pattern. You want to make sure they are stood up and ready to go. This is just a broader snapshot of regional quit levels throughout the economy, and focusing in on the Midwest, the West, the Northeast, and the South. And it's a bit on the nose, but you can see more weakness coming out of the West Coast, that top right quadrant. And that's akin to just softer economic variables out of that area, especially thinking about the tech sector, the office space trends, all placing downside pressure, as well as just the population migration trends. And if we think about population migration, there's been a bigger, larger influx into the South, and you can see that the South has much higher levels of regional quit levels, again, akin to having a little more leverage as an employee in those stronger regional markets. And while we're talking about markets, let's take a poke around some of your markets. Looking at the various vertical markets that are included within your reports, always want to highlight the right products and services to sell in this slowing growth environment that we will experience this year. Emphasize your return on investments, and then also look to eliminate unprofitable business segments to free up some cash and other resources to make those key decisions this year to prepare for that 2025 growth. So the first pit stop that we're going to take, looking at construction machinery new orders. The left side is the 12-month moving total. The right side is the year-over-year rates of change. We are talking about a pretty imminent transition from slowing growth into recession here within the next 2 quarters. Really, prior weakness in the housing market is likely to manifest in new orders in the coming quarters, as lower levels of building influence construction companies' capital investment decisions. Thus far, infrastructure investments have likely staved off some of that decline due to the large influx of cash from government grants and subsidies, but our analysis indicates that this level of investment is generally unsustainable, so we're planning for lower levels of new orders this year to the tune of almost negative 14%. Now, with that said, pockets of opportunity will exist even on the backside of the business cycle. Look to advertise in relatively sheltered sectors or regions that are benefiting from positive demographics. Again, thinking about the South, thinking about those infrastructure spending needs and manufacturing construction, to name a few. Now, additionally, we look at the North America light vehicle production. Within this industry, recent months have been stronger than we anticipated, and that's reflective of a more resilient middle to upper income consumer. With that said, dealer inventories have been consistently low despite this rising production. That's in part due to double-digit light vehicle retail sales, which indicates just the pent-up demand that continues to ripple through this space. With all of that said, we lifted the production forecast for light vehicle production. We are now not anticipating a recession in this space in 2024, more muted growth in 24 and 25. If possible, look to increase your exposure to the electric vehicle market, which is poised for long-term expansion given shifting consumer preferences, government subsidies, and changing environmental regulations. Now, on the flip side, when we talk about the vehicle space, we also look at heavy-duty trucks, which is expected to experience more weakness this year and recessionary trends this year. Talking about a 12-12 rate of change in that right chart that is heading towards recession imminently. Inventory in this space were built up following the COVID era shortages and have since flattened out, and they currently stand just shy of the mid-2023 high at about $2.9 billion. And so those elevated inventories will discourage production as already waning freight activity further declines with U.S. industrial production. And then just given the high cost of heavy duty trucks, production tends to be more interest rate sensitive. And that is still a key challenge. Elevated interest rates are likely to contribute to downside pressure on this production this cycle, followed by a pickup in 25 and even into 26. Oil and gas space, because we need those for our vehicles. What we're looking at within the oil and gas space is some upside risk. Natural gas production is holding up really well with the 12-month moving average setting record highs. Additional growth is probable given that the 3/12 rate of change for that natural gas production is running above the 12/12 rate of change. And when we look at just the overall capacity situation, that's also on a 3/12 rate of change basis, reflecting a rising trend and an increase in utilization from 1 year prior. Now, the downside here is that many oil and gas firms expect their CapEx to remain the same or even decline a little bit in 2024. The Dallas Federal Reserve survey shows that 57% of oil and gas firms respondents expect that to be the case for 2024. While I did mention oil and gas capacity utilization is rising, it is near full capacity, and that could limit the potential growth in this space. And if we couple that with lower levels of capital expenditures, it could stunt future growth here. So we definitely want to keep an eye on the capacity within the oil and gas space and its ability to grow. It is a limiting factor here. But overall, the current expectation or forecast is a mild decrease in 2024 with some upside potential to avoid recession within this data series and continue to grow in 2024. Another space that we expect a little more upside in 24, thinking about growth, is within the medical equipment and supplies production. You can see this space has showcased a little bounciness, or expected to showcase a little bit of bounciness within the 12/12 rates of change. We can look at just the revenues within this space or the medical lab revenues in this space. We can look at just the counter cyclicality or typical cyclicality of this space. And we also just recognize that there's some positive momentum in those 3/12 rates of change. It's going to give it a near-term lift. And we expect that lift to really carry it through 2024, growing at about 1.9%. And then following that, we're looking at about a 0.5% decrease in 2025. So again, more modest growth activity within this, the medical equipment and supply space could provide some opportunities to run countercyclical within your own industry's data. So potential for growth there. Another potential opportunity for growth is the Civilian Aircraft Equipment Production Index, talking about the aircraft space, showcasing that growth is on the horizon. Over the last 3 years, Boeing commercial aircraft deliveries, 12-month moving total, has recovered by about 57%. Now, that recovery is after a very precipitous drop. You can see happened there from 2018 into 2020. It was on the backside of the business cycle. COVID really sped that up and it plummeted. With that said, that deliveries from Boeing has not been enough to keep up with the record high new orders. And it's important to note that there is potential for future cancellations there. But when we look at only non-cancelable orders, Boeing commercial aircraft undelivered firm orders has increased by 16.6%. And so we expect production to resume rising in the near term to fulfill that really elevated backlog. What might slow that down? Recent safety concerns, regulatory pressures, and that might extend or delay that production and a downside risk to 2024. What we want to say here is just analyze the strengths and weaknesses of your supply chain, both upstream and downstream, to see if you can play a role. Can you find opportunities to diversify or strengthen your role in this market? Another segment of the economy that's experiencing some upside from those government incentives is talking about U.S. computers and electronics new orders. We do expect the ongoing tick up in the new orders 12/12 rate of change to be generally short-lived. We're talking about really a slowing growth cycle from a predominant theme with a mild uptick the next 2 quarters. Really, that general business cycle decline is being seen in the broader industrial sector. We expect that to start to manifest itself in the first half of this year. Evidence for this expected general decline can be seen in movements from US computers and electronics exports, which suggest waning global demand for computers and electronics. We'll continue to monitor those. We're also looking into just the potential, or what's driving this is the semiconductor market and nearshoring opportunities, placing some upside risk to this segment of the economy. And as always, order cancellations, they remain a risk to many business pipelines as the industrial sector falters. Just avoid relying too heavily on new orders in your planning efforts. Make sure that you have some hedge against those order cancellations. And lastly, wanted to poke around US farm machinery shipments. This chart right here, looking at the 12-month moving total on left, 12/12 rates of change on right. What we're experiencing right now is a troughing within the 12/12 rate of change. This is the worst of the decline. In this space, it feels like it's the worst of the decline. We expect to see an upward momentum in close 2024 relatively flat relative to 2023 before showcasing stronger growth in 2025. Now, decline in the prices of commodities such as corn and soybeans has really cut into farm proprietors' income. Elevated interest rates have also impacted their ability to finance agricultural machinery, both domestically and abroad. And that's what's placing some of that downside pressure and muting the recovery into early 2025. As we kind of wrap up for the day, I wanted to just highlight just a couple of key themes. Disinflation, deflation, that's going to categorize 2024. There'll be some easing of the wage inflation, but again, I like to say things will get easier, but not easy. Make sure that you're focusing in on those process efficiency gains. Make sure you're focusing on retention efforts. Make sure you're focusing in on your training. And also thinking ahead, looking into 2025, make sure that you are looking into your labor and assessing how long it takes to get an employee to be fully productive. And the longer it takes, the sooner you want to make those hiring decisions to get in front of 2025 as again, emphasis on not being overly reliant on too many new workers during an accelerated growth pattern. You want these workers to be well trained when that's happening. It's much easier to do it that way. Expect interest rates to ease lower into 2024, likely early 2025. So if you are looking to make any investments, capital investments, and you're looking to borrow to do so, you'll face an easier interest rate environment later this year, early 2025 to do so, with the caveat that ITR does have a longer view of the economy heading into the 2030s decade. And our recommendation is to make sure that the maturities of any investments that you take out, any loans that you take out, are timed appropriately so you're not carrying a lot of debt into the 2030s. Now, again, to kind of emphasize the GDP growth factor, there's a lot of things underpinning GDP growth. So when we go to that middle bullet here, the middle chart or square here, we are expecting the service sector to hold up better than private manufacturing this year. That's what's propelling a lot of the growth in GDP. As we showed, industrial production still expected to enter into a recession. Manufacturing as a whole has entered into recession in 2024. And that is expected to be the key theme in 2024. But I want to think about this year as an opportunity to invest in yourself, your time, your money, into setting yourselves up for growth coming out of 2024. What's going to continue to provide buffer and additional opportunities, those fiscal policy and government initiatives, thinking about the Inflation Reduction Act, thinking about the CHIPS Act, thinking about the infrastructure spending bill. All of these provide some excess opportunities that will provide buffer for the economy, as will just the overall level of corporate cash, businesses holding higher levels of corporate cash, are going to be more resilient to the higher interest rates that we are currently facing. Now, heading into this year and really longer term, make sure that you're assessing your cash needs, make sure that your budgeting is planning for this slowing growth and even downside and recessionary within 2024. Make sure that you also are planning to have the cash in place for when the economy picks back up. When we think about just looking inwardly and using the time investment this year, make sure you're homing in on your competitive advantages. Quantify what it is you do well, how well you do it, and quantifying it in a way that you can trumpet it in the marketplace so you can be part of the solution to things like efficiencies, to shortening lead times, to higher quality output, and make sure that you can, again, capitalize on that to gain market share. And then longer term, just think about the diversification, think about the innovation, think about the asset class you're invested in, plan to time out with that longer term view that ITR has of weakness within the economy come 2030s. So something to think about today, hopefully folding this insights into your planning. But with the last few minutes of our time, why don't you open it up with any thoughts or questions that you all may have? You can either speak up or just plop them into the chat window. So regarding the producer price index and specific to heat treating, the Fed data is not looking like the producer price index that we are showcasing there. And I appreciate the link, because what I'll do is I'll pop that link up and let's take a look. Place this link here. What we're seeing is that through January, the producer price index for metal heating continues to pivot upwards. It hasn't hit that high level bend over. What I would love to do is focus in on the rates of change in this industry, which I don't have framed out in my head, but what I can do is I can take this data and I'll send it to Tom and maybe he can disseminate it. And we can just look at what the 312 rate of change is doing in this space. This is monthly data continuing to surge upwards. Was placed a lot of upside pressure within a variety of segments of the industry is those repeated wage pressures. And so the more sensitive a business is to those higher levels of wages, the more likely it's feeling the higher push up within the overall prices and costs. If we were to kind of poke underneath the hood, I'm curious how we can quantify the impacts between raw material costs and overall labor costs and try and disseminate the core drivers of this. And that's a key takeaway that I have looking at this, is to dig into that research and provide some of those insights. Off the cuff, I don't want to provide any bad looks or any wrong guidance, so I'd love to do a little follow-up analysis and disseminate it to the group. Any other thoughts or questions? And if not, I hope everyone has a great rest of their week and an excellent weekend. This recording will be sent over to the team at MTI along with the presentation and report. As always, if you have any additional questions after the fact, please don't hesitate to reach out to us. Thank you and have a great day.